Hey everyone, Celia Dell here, and let's talk economics. When you hear trade deficit, what comes to mind? Factories closing, jobs moving overseas, panic on the news? You know, the usual doom and gloom. What if I told you that everything you think you know about trade deficits might be wrong, like totally, completely upside down wrong? It sounds crazy, right? But Nobel Prize-winning economist Milton Friedman, Milton Friedman, believed trade deficits aren't a problem at all. In fact, he thought they were a sign of a strong economy. We're talking about a world where a deficit isn't something to fear, but maybe even celebrate? Okay, maybe not celebrate, but definitely not panic about. Stick around because in this video, we're going to break it down with 15 real-life facts that will completely change how you think about trade. First things first, let's define our terms. What exactly a trade deficit? In the simplest terms, it means a country imports more than it exports. Think of it like this. Imagine you're buying more stuff from Amazon than you're selling on eBay. That's a personal trade deficit. On a national level, it looks like the United States buying more electronics from China than it sells back to them. We love our smartphones and laptops, and China's really good at making them efficiently. So, we buy more from them, leading to a trade deficit. It's like that friend who always has the best snacks. You're always going to end up with a snack deficit with them. But unlike with your friend and their delicious snacks, a trade deficit with a country isn't necessarily a bad thing. Now let's talk about where we track all this trading activity. It's called the balance of payments, and it's basically a country's bank statement. Just like your bank statement tracks your income and expenses, the balance of payments tracks all the money flowing in and out of a country. Within the balance of payments, there's a section called the current account, and that's where we record trade deficits or surpluses. It's like the shopping and entertainment section of your bank statement, showing where you spent money on fun stuff. We need to look at the bigger picture, the overall economic health of a country, to understand what a trade deficit really means. Okay, so when you hear about trade deficits, it's almost always followed by a chorus of, "They took our jobs, but did they?" Milton Friedman argued that jobs don't disappear because of trade deficits. They shift based on productivity. Think about it. We used to manufacture a lot of clothes in the United States, but now those jobs are mostly in countries with lower labor costs. Does that mean the US economy is worse off? Not necessarily. Instead of making clothes, we're now focusing on things like software, technology, and high-end manufacturing, areas where we have a competitive edge. This shift in jobs is driven by specialization and efficiency, not some nefarious plot to steal jobs. It's like when you were a kid and realized you were really good at drawing. You might have stopped doing chores to focus on your art, not because you were trying to get out of chores, though that might have been a bonus, but because you were more productive focusing on your strengths. The same goes for countries and their economic output. Chapter 4: Trade Deficits and Economic Superstars. Here's a fun fact that might surprise you. Many of the world's strongest economies, the ones we usually think of as economic rock stars, have been running trade deficits for decades. Take the United States, for example. We've had a trade deficit for over 40 years, and guess what? We're still a global economic powerhouse. How is that possible? Well, remember what we said about the bigger picture? A trade deficit doesn't exist in a vacuum. It's part of a complex web of economic activity. The US has a strong, diverse economy, a highly skilled workforce, and a stable political system. All things that attract foreign investment. And that foreign investment helps to fuel our economic growth, even if we're buying more stuff from other countries than we're selling to them. Chapter 5: Trade Deficits, Not Spending, but Investing. Here's where things get really interesting. A trade deficit isn't just about buying more stuff from other countries. It's also about those countries turning around and investing that money right back into our economy. It's like a financial boomerang. Let's say Japan sells a bunch of cars to the United States. They earn US dollars from those sales, but what are they going to do with all those dollars? They could convert them to yen, but often they'll invest them back into the US economy. This could mean buying US real estate, investing in US companies, or buying US government bonds. It's like lending money to a friend you know will pay you back with interest. Except in this case, the friend is the US economy. This cycle of investment helps to create a dynamic, interconnected global economy. So, the next time you hear about a trade deficit, remember it's not just about spending, it's also about investing. And that investment can lead to growth and prosperity. It's a win-win situation for both countries involved. So, don't fear the trade deficit, understand it. Chapter 6. From trade deficit to job creation. Remember those foreign investments we were just talking about? They have a really cool side effect: job creation. When foreign companies invest in the US, they often build factories, open offices, and hire American workers. Think about Toyota building a manufacturing plant in Kentucky. That's Japanese investment creating American jobs. Or a German company opening a tech office in Silicon Valley, employing American engineers and programmers. It's the flow of goods and services, the flow of capital, that create a dynamic, interconnected global economy. This might sound counterintuitive, but a trade deficit can actually be a sign of economic strength. Why? Because it often means that investors around the world have confidence in your economy. It's a vote of confidence in the long-term prospects of that country. Now you might be thinking, okay, if trade deficits aren't so bad, then trade surpluses must be amazing, right? Not necessarily. Just like trade deficits don't tell the whole story, neither do trade surpluses. Take Japan, for example. Japan has had a trade surplus for decades, meaning they export more than they import. But they've also experienced slow economic growth for much of that time. This is because a trade surplus can sometimes be a sign of weak domestic demand. So, a trade surplus isn't always a sign of a thriving economy. Here's the key takeaway. You can't judge an economy solely based on its trade balance. It's like trying to judge a book by its cover. You're missing the whole story. Some countries might have trade surpluses because they export a lot of natural resources like oil. But that doesn't necessarily mean they have a strong, diversified economy. So, the next time you hear someone freaking out about a trade deficit, remember to zoom out and look at the bigger picture. Chapter 10. Productivity, the secret sauce of sustainable trade. Now let's talk about sustainability. Can a country run a trade deficit forever? The answer is, it depends. If a country is productive, innovative, and continues to attract foreign investment, then yes, a trade deficit can be sustainable. Think about the US again. Every day new startups are launched, attracting capital from all over the world. That's money flowing into the US economy, fueling innovation and growth. As long as we maintain a high level of productivity and continue to create things that the rest of the world wants, then a trade deficit is nothing to worry about. It's all about staying competitive and innovative. Title deficits versus debt, apples and oranges. One of the biggest misconceptions about trade deficits is that they're the same thing as national debt. This is like saying that ordering takeout is the same as having student loans. Sure, they both involve spending money, but they're completely different things. A trade deficit is simply the difference between a country's imports and exports. National debt, on the other hand, is the total amount of money a country owes to its creditors. It's important to keep these two concepts separate. A country can have a trade deficit without having a lot of national debt, and vice versa. So the next time you hear someone using these terms interchangeably, you can gently correct them and drop some economic knowledge. Chapter 12. Fast growth, big appetites, trade deficits. Here's another interesting fact. Fast-growing economies often run trade deficits. Why? Because they're busy importing all the stuff they need to expand. Think about a plant needing extra water and sunlight to grow taller. It's gobbling up resources to fuel its growth spurt. The same goes for countries. When an economy is growing quickly, businesses need to invest in new equipment, hire more workers, and expand their operations. It's a sign of a dynamic, expanding economy, not something to be feared. Now, let's talk about tariffs. Governments often slap tariffs on imported goods as a way to protect domestic industries and reduce trade deficits. But here's the thing, tariffs don't really work. Think of it like this. Let's say you love buying shoes from a particular online store because they have the best prices and selection, but then the government imposes a hefty tax on all shoes purchased from that store. What are you going to do? You're probably going to find a different online store, maybe one with slightly higher prices but no extra taxes. The same goes for countries and tariffs. Here's another reason why tariffs and protectionist policies are a bad idea. They hurt consumers. Remember those shoes you loved buying online? Well, now they're more expensive because of the tariffs and you're stuck paying the difference. Tariffs lead to higher prices for consumers, reducing their purchasing power and slowing economic growth. It's far better to focus on creating a competitive, innovative economy that can compete in the global marketplace, rather than trying to shield domestic industries from competition. So, if trade deficits aren't something to fear and tariffs aren't the answer, what countries be focusing on? The answer is simple: innovation and productivity. Take South Korea, for example. A few decades ago, they were a relatively poor country, but they made a conscious decision to invest heavily in education, technology, and innovation. They didn't achieve this success by trying to protect themselves from the global economy. They embraced it, focused on their strengths, and became a major player on the world stage. So there you have it. 15 mind-blowing facts about trade deficits that just might have changed the way you view the global economy. If you learned something new today, hit that like button, share the video, and subscribe to Money Hacks for All Ages for more economic breakdowns made simple. We love making economics accessible and, dare I say, even a little bit fun. And be sure to let us know in the comments. Should countries worry about trade deficits or focus on innovation instead? See you next time.